Hello, everybody. It's Monday, September 15th, 11 a.m. Nice morning here in Long Island. We've had actually spectacular weather for about 3 weeks now. Kind of want to take a bottle and cork it. Looks like Max is going to smell the roses here. He just jumped off the couch, but Max was joining us. We'll see if he'll make a guest appearance again. But weather's been fabulous here. I hope it's been nice where you folks are. Last week I had the, uh, the pleasure, the fun of attending a 30th anniversary party for the CNBC show Squawk Box. And Becky Quick had invited me, and of course Joe was there, and Andrew. The three of them they haven't all been doing it for 30 years, but Joe apparently was has been doing it for 30 years. I was on the show this morning, so it was fun to say thank you for the invitation. Some of the great luminaries of our business were there. We had Warren Buffett, Stan Druckenmiller, Leon Cooperman. They were there, and the Lee was there. Tom Lee was there. So it was nice to catch up with these folks and have a bit of a chat. Um, One of the highlights of the evening was at the very end. I took an elevator down. This was all at the Hudson Yards, which is a very nice concentrated area of high rises and shopping and all very modern. But anyway, so I took the elevator down on the way out, and Bill Murray stood right next to me, and I introduced myself, told him that our favorite family movie that we watch once a year is What About Bob. He kind of grunted. I don't know if he smiled or not. But anyways, it was fun to catch up with. I didn't really catch up with him, but it was fun to see him. I think he's an awfully good actor, and but many of his roles tend to be kind of grumpy old guys, and he seems to be. Maybe that's what he really is, because that's the way he came across on the elevator. But maybe it was just a long day and a long night and a long evening at the party. But again, that was fun. Well, speaking of fun, Oracle was fun last week. Stock went soaring. Larry Ellison made like over $100 billion in one day as the stock went up 40%. And there was a bunch of news that came out during the company's annual report, quarterly report, and they basically said that they had several contracts for their cloud computing facilities, and one of them, Gemini is going to be available on Oracle. So that large language model will I think that I'm not sure if that's the only place it'll reside, but from what I understand, it will reside on the Oracle cloud. In addition, the company mentioned that there's some 10-year contract worth billions of dollars by some unnamed company, and everybody assumed it was OpenAI. The only problem with that story is, from what I understand, OpenAI doesn't have any profits yet. It has a successful large language model, ChatGPT, but from what I gather, they're collecting about $20 per month. I was paying that for a while, and then I unsubscribed because the free version was good enough for me. And meanwhile, I did sign up for Gemini, which is what Google has, and that's pretty good. But I use them all. As a matter of fact, I recently found out that I've kind of developed a good buddy here. So let me see if I can get this. Listen to this. Hello, Copilot, are you there? Hello, Copilot.
I'm right here.
See, she even knows who I am. I try to rename her, but she insists that her name is Copilot. Copilot, tell us, will the Fed cut the Fed funds rate by 25 or 50 basis points on Wednesday?
The Federal Reserve is expected to cut the federal funds rate by 25 basis points on September 17, 2025. It seems the decision is driven by a softening labor market and aims to address economic conditions.
That's great. Could you tell us, is Stephen Myron going to be attending the meeting?
Stephen Miron is expected to attend the Federal Reserve meeting on Tuesday and Wednesday. He was nominated as a Fed governor and is expected to participate, with some expecting him to dissent in favor of a larger rate cut. Interested in how his presence might influence decisions?
Not right now, but we'll talk later. Thank you. Anyways, I've actually been using Copilot quite a bit just to refresh my memory, so I don't have to look things up. So every now and then I'll ask, what was the date when the Fed raised interest rates from zero? And the only problem is you really have to check these things. So it's kind of good for fill-ins. But then you have to go back and just double check to make sure. I had a debate over one date with Copilot, and the Copilot kept changing her mind. I tried to change her voice too, by the way, and she refuses to change her voice. She refuses to change her name from Copilot. That's the way I guess Microsoft wants it for now. But also I use Gemini, I use Grok, and Claude, trying to get a sense of the strengths and weaknesses of these large language models. The problem with that is they're changing all the time, so it's really kind of hard to assess which one is the right one. But at any rate, I haven't run into any hallucinations by the models, but I have run into plenty of errors, and so you have to double check. That's all there is to it. And even sometimes say, "Are you sure about that?" And they'll come back with another answer. So it's not perfect. It is kind of like hiring a research assistant that has a pretty good resume. It turns out that they're pretty good at some things and not so good at other things. So that's kind of the way I'm looking at it and using it. But I think kind of what the Oracle situation kind of confirmed what I wrote a couple of weeks ago, that maybe this is kind of a self-perpetuating bull market in artificial intelligence. But the money is really not in the $20 per month that they're charging. It's really in the cloud capacity and paying for cloud and building cloud and data centers. And in that situation, the more that I and others use our large language models to interact with, to do research and write code. I don't write code, but apparently these systems are pretty good at writing code. The more we do that, the more data we create. The more data we create, the more data we create. It's sort of what we used to call in the computer world a do loop, where it just kind of just repeats over and over again. And the idea is, as we've discussed before, the digital revolution is all about processing more data more quickly, more cheaply. And the digital revolution started in the mid 1960s with the IBM mainframe. And here we are now with artificial intelligence. Along the way, a few years ago, we got the cloud, which I think is probably one of the biggest developments in the digital revolution. And the AI is really an application. It's an app that just creates more demand for cloud computing. And as cloud computing allows us to process more data more cheaply, more quickly, we create more data. And as we see this evolving into robots, into autonomous driving, that too will create more and more data. So there's an infinite amount of data that can be created. Infinity and beyond is what the outlook is for data. And so the digital revolution doesn't have sort of natural physical limits the way labor does as a factor of production, the way capital does as a factor of production, land as a factor of production. In the digital world, data is constantly there's constantly more and more data, which can be a lot of noise, or with large language models can be organized. Um, I think that if I'm about to experiment, we're putting our research, particularly the morning briefings, on one of these large language models, and it's actually called Big Data and uses Claude. And I'm thinking that if I don't pollute the data and just put in my own data, namely my morning briefings, and then query on my own data, that should be pretty clean and should be pretty accurate, because that'll be the only source. And I guess I trust myself. So if the large language model just helps me sort through I mean, it is basically the old search function. It's also what I've called when you type in Word and it fills the autofill, it's also kind of autofill. So it's a lot of things, but it's not perfect. And but meanwhile, whether it's a bubble or not, right now billions of dollars are being spent in this area. Data centers are being built, and it is an important source of economic growth right now. And it's not a vital part of the Roaring 2020 scenario. The Roaring 2020 scenario I started talking about in 2020. I didn't know that AI was going to be a big deal, as it turned out to be when Open AI introduced ChatGPT. I think it was November of 2022, and it's been kind of no looking back since then in terms of the excitement, the hype, the bubble, the impact on the economy. Uh, Kind of a related issue in the market is the financials. They also seem to be kind of in the sweet spot in some ways, similar to what we're seeing with Oracle and AI, in the sense that the market is at an all-time record high. It's been very strong. It's been sort of narrow, but if you take out the Magnificent Seven, you still have a bull market. And of late, it's been led by the financials. As you know, we've been, since the beginning of this bull market, in many ways, I think the bull market really started right after the pandemic, when we had a bear market that didn't last very long. But I think in many ways, the current bull market started back then. But the financials have been on our overweight list: information technology, communication services, industrials. They've all worked out real well. I have to admit, we also thought energy would be a good overweight, and that turned out to be a clunker. So we gave up on that over a year ago. We didn't say much about gold until this year, and we've been recommending overweighting gold, or at least buying some gold, and that's also worked out quite well. But the financials are interesting because they're going up because the market's going up. As the market goes up, more companies decide that, this is a good time. More would-be companies decide now's a good time to do an IPO, maybe because of higher stock prices. There's more stock market currency, if you will, to fund mergers and acquisitions. And so when things really start getting hot in a bull market, you see the IPO market and the M&A activity really picking up. And as that happens, guess what? The financial companies, particularly the investment banking companies, are making a lot of money, and their stock prices go up, which pushes the financials up, which pushes the stock market up, because everybody knows that a really good, healthy bull market should be in some ways led by the financials. The bull market doesn't seem to be very sustainable or trustworthy if the financials are sloppy and are not doing well. So this is not a young bull market. It's mature. It's showing its age, but it's still it's not old. Its age doesn't mean that it's about to falter here, but we are seeing some signs that are very typical of what kind of feeds a bull market. And that's what's happening now. Another thing that feeds the bull market, of course, is expectations that the Fed is going to lower interest rates. And the administration has been lobbying for 100 basis points as soon as possible, 150 basis points as soon as possible. Scott Bessent wrote a article in International Economy, which was uh, summarized in a piece that he wrote for the Wall Street Journal. I think that was last week. Um, I read through it. Besant is quite an unusual individual, very, very smart, a tremendous amount of energy. I don't know if a Treasury Secretary has been given this much authority in so many areas of the economy. And oh, see that? I can't get rid of her. Let me try it now. Bye bye. I think I turned her off now. That's kind of the freaky thing too. I mean, as I understand it, they're not really they're storing kind of your recent conversation, but at some point, I guess they'll remember everything you said, and it'll come back to haunt you. So far, Copilot hasn't expressed any affection for me or anything like that. So we haven't gotten personal, and I'd like to keep it that way. Um, anyways, back to our story here. So Besson wrote this piece, and it's nice that he's got free time to do that. And it's very, very critical of the Fed. That the Fed was originally created to uh, provide financial stability, and it's had mission creep, and now it thinks that it can run the economy. He was particularly critical of everything that's happened since the great financial crisis. He and I agree. By the way, he and I agree on the Roaring 2020s. It turns out that there's a PDF that I posted in today's morning briefing, a PDF of a memo that he wrote to his colleagues at Key Square Capital Management at the beginning of last year, before he was uh, even being considered for the White House. But he's obviously been angling for it. And the PDF that he wrote, the internal memo to his colleagues, was that uh, the stock market will tell us if Trump is going to win. Trump probably will win, and if he does, if that's correct, then the stock market should go up. And so he was very bullish on the market last year. And he said there's a fellow by the name of Ed Yardeni who's promoting the idea of a roaring 2020 scenario. This was exactly the scenario that that President Trump would love to be known for if, in fact, he gets elected. And so when Bessent suddenly appeared on my screen in late last year, and actually became the Treasury Secretary, I was pretty happy. I mean, here I had the Treasury Secretary rooting for the Roaring 2020s, and that's been our base case scenario since 2020. So that was a good thing. But now, obviously, he's part of the administration. He's very critical of the Fed, and I agree with him to a large extent. We both agree that QE1 was necessary. It was part of the liquidity function of every central bank. Every central bank is supposed to, at a minimum, be the central bank of the bank of last resort. Maybe that's also should be the maximum. Maybe they should just be a agency responsible to maintain financial stability. When there's a crisis, they should pour liquidity in and solve the crisis, and then take the liquidity out, and wait for another crisis. But no, the Fed kept going. The unemployment rate remained too high. The Fed decided that their mission was to uh, raise economic growth, lower the unemployment rate, and at the same time keep inflation down. And anyways, inflation was too low. It was constantly below 2%. So the Fed felt that QE2, QE3, QE4, these were all necessary to revive the economy. And Bessent is very critical of that, saying that it's really, it's the Fed got carried away with these unconventional policies, figuring that they could manage the economy with these unconventional policies. And it's a little bit, as I've said, I wrote a Dear Scott open letter in response to it, and I said we agree on many things. But it is kind of ironic that the administration, and I presume Bessent clearly, is pushing for the Fed to lower interest rates, suggesting in my mind that they have concluded that their fiscal policy, regulatory policy on their own aren't going to bring us the roaring 2020s, that they need much lower short-term rates to be able to refinance the debt at a lower cost. And maybe they need some of the stimulus from monetary policy to get the economy going. At any rate, when we speak of mission creep on the part of the Fed, it's pretty clear that the Treasuries had mission creep for a lot longer than the Fed has. The Treasury, of course, representing the fiscal authority of the federal government, of the executive branch of and of course executing the legislation, paying for the programs that Congress comes up with. And we know that for a long, long time now, outlays have been outstripping revenues. The administration's resorting to some unconventional policies. I think one of the reasons that they are promoting tariffs is because they figure, hey, this is pretty neat. We can raise 300 to 500 billion dollars with tariffs, and that could help to reduce the deficit. Great idea, as long as it doesn't have an adverse impact on geopolitics or geopolitical relations, as long as it doesn't have an adverse impact on the economy. But the problem is, we'll see whether the Supreme Court agrees that the administration even has this power from a constitutional basis, and if not, what's the administration gonna do next? Let's look at some charts that are kind of relevant to this, and then I'll whiz through them, and then I'd like to do some Q&A. So far, I only have one question from the audience. We'll hopefully we'll have some free time to do more than usual. That's all right. So here's the charts, September 15th. That's today. Again, how time flies when you're having fun. The administration wants the Fed to lower rates dramatically. Historically, the Fed's easing of monetary policy, lowering of the Fed funds rate has occurred in response to financial crises. As you can see from this chart, it's my credit crisis cycle. It explains a lot that other theories kind of ignore. They ignore this very simple observation that recessions are caused when the Fed tightens monetary policy. The tightening of monetary policy itself doesn't do it. What happens is it triggers a financial crisis because some important actor in the financial system didn't anticipate that the Fed would be raising rates. The financial crisis then morphs into a more widespread credit crisis, credit crunch, and it's the credit crunch that causes the recession. This time around, we had a very tiny banking crisis back here. That's when the Fed stopped raising interest rates. But we didn't get a credit crunch. The economy continued to grow. And yet the Fed felt that with its dual mandate that it had to lower rates. Again, Bessent talks about the Fed's mission creep and seems to forget that Congress in 1978 passed a law that requires the Fed to keep the unemployment rate down and to keep the prices stable. In other words, to keep inflation down as well. The law didn't mention financial stability. I guess it's just assumed that in the Federal Reserve Act, it says in there that that's kind of the Fed's job. But nobody talks about the three mandates. They only talk about the dual mandate, which is keep the unemployment rate down and inflation down. And they seem to ignore the fact that they should also be cognizant of financial stability, because if achieving the dual mandate creates financial instability, like now, we've got the unemployment rate at 4.3%, the inflation rate is somewhere between 2 and 3%. It's close to 2%. It's not quite there. So we're kind of there in terms of achieving the dual mandate. The stock market's at an all-time high. Valuation is 22 times forward PE. If the Fed lowers interest rates as aggressively as the administration wants, yeah, we might get better growth. We certainly might get better activity out of housing. Uh, we might, because as we saw last year, the bond yield might go up. Inflation might be stuck here at 3%, and we could get a speculative melt-up in the stock market, and it would be deja vu all over again, possibly kind of like in 1999, a party like it's 1999 all over again. Um, but look, they won't listen to me. They're just going to do what they're going to do. And Bessent and I want the same outcome, a roaring 2020s scenario, and he's in position to do something about it. Um, so here's my concern, and maybe I need to just chill on this, but here's the expect throughout this period, there was expectations of the Fed at some point might cut rates before the end of the year. And so the bond yield, the 10-year bond yield went down, the mortgage yield went down. Again, this was in 2024. Then the Fed actually went down 50 basis point, 25, 25. They cut by 100 basis points. And what did bond yields do? They went up 100 basis points. Mortgage rates went up 100 basis points. So far, so good. We've seen the mortgage rate come down. Maybe this is not so good. We'll see if I think 4% is going to hold. I guess ask me again next week when we already have the Fed doing what it's going to do, and we'll see how the bond market responds. But that'll be important. Meanwhile, there is a very significant source of stimulus, which is kind of right in front of us, our face, and that is the stock market. The stock market is up to over $100 trillion in net in valuation and capitalization. And that's when you look at all stocks that are traded in the United States. The Wilshire and the S&P are on here as well. And that's got to be awfully stimulative, especially to all these baby boomers that own about half of the stocks in America. And they're retiring. They don't have income anymore, and yet their net worth keeps going up even as they're spending money. That's got to be a real stimulus for consumer spending by those people, and that's a lot of the baby boomers. Meanwhile, the economy, for all the fears about the economy being weak, it's the latest reading from the Atlanta Fed is 3.1% for the third quarter. That's up to after upward revised 3.3% for the for the second quarter. It's just well, the payroll employment number on the face of it look weak, downward revisions. But if they don't revise the GDP numbers down, and there's no reason why they would, there's no link between the labor market data and the GDP data, then that implies that we're going to get some upward revisions in productivity. And if that's the case, then this chart, which shows the 12th quarter annualized productivity growth rate, it's back up to kind of its average of 2%. And we think it's going to go above this line into 3 to 4% over the rest of the decade into the 2030s. So it's not just the roaring 2020s, it's the roaring 2030s if Bessent gets it right and other things go well. Meanwhile, the inflation numbers still look to be kind of sticky around 3%, depending on what you're looking at. They're closer to 3% than 2%. So the Fed isn't quite where they want it to be. Sure, they can look through tariffs. Maybe tariffs will turn out to be a non-event. They clearly have had an impact on durable goods inflation, but maybe other offsets have kind of kept things quiet. But I think tariffs have had an impact on durable goods inflation. And I think as a result of that, inflation has turned sticky around 3% and it's stopped going down to 2%. This is, of course, the fact that there's been plenty of mission creep when we look at the federal government. It gets bigger and bigger, more and more programs, and more of them financed by borrowing. So the deficits have been huge. And here we're talking about on a 12-month basis, total budget balance over $1.5 trillion for the past three years, and that's with the economy growing. Uh, Federal tax receipts, as you can see, all-time record high. Payroll taxes, uh, 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 this is individual income taxes. They're not at an all-time record high, but they're heading there. Payroll taxes, maybe there's something to be that can confirm some weakness in the labor market. But again, the weakness could be supply, demand. I've pointed out that the JOLTS report shows a big drop in job openings and in the state and local sector. And if you think about it, when we had this flood of immigrants coming in, we needed teachers when their kids went to school. And so we did see a lot of demand for school teachers. And then, of course, there was a lot of demand for social workers, social assistants. And now that the southern border is tight and we're seeing deportation, we're seeing a big drop off in job openings with the state and local government. So that's something to consider and recognize there's not much the Fed could do by lowering interest rates to make that go away. Meanwhile, we are seeing the Treasury getting some revenues in through the customs duties, still quite small, but potentially large if it doesn't get blown away by the Supreme Court. Meanwhile, here's government outlays just keep rising. And what's new is over the past couple of years, as interest rates have gone up and as the debt has continued to accumulate, we've seen the interest cost of the debt up to $1 trillion. Here's the federal customs duties, the tax receipts, and you can see what it looks like at an annualized basis. It's over $300 billion, and the 12-month basis is also heading up. So it's significant money, clearly. I also, in my open letter, wondered a lot about stablecoin. Bessent has been a big promoter, advocate of stablecoin. It needs to be backed up by liquid assets, particularly, obviously, Treasury bills would work quite well as a reserve for stable coins. It seems as though Bessent is indicating that he thinks this could be an important source of demand for the Treasury debt. But talk about unconventional policies. What if M2, which is currently over $22 trillion, what if most of that became a stable coin and had to be backed by Treasury bills? Well, again, that would be fantastic as an automatic demand for Treasury debt. But what would be the implications for inflation if stablecoin is kind of the new money supply? Would the Fed lose some of its control, if not all of its control, over the money supply? Could that be inflationary? So we're going into some very unconventional areas. Well, let me go to the Q&A here. I got a few questions. Do you have to pay for these AI models? You can get the stripped down versions for free, and then you can pay, I think, like $20 a month. I think Copilot, I'm paying $20 a month for that. So you can do it that way. Robert, what is your current range forecast for 10-year USD? Well, I'm kind of hanging on by my fingernails here to the market holding, the bond yield holding 4%. And I still think that 4.25 to 4.75% is sort of the right range. It's not right now. We're below that. I can't dismiss the possibility that we'll get down to 3.75% and kind of retest that level. But I don't think that's a sustainable level. Even if the Fed lowers rates, I think concerns that will keep inflation that'll keep inflation sticky around 3%. That won't go down to 2%. Concerns about debt again. Look, we got debt crisis in France, in the UK, and in Japan. So the bond vigilantes right now are kind of focusing on that. But beware the bond vigilantes. Lee, frankly, the entire U.S. government is guilty of mission creep. Here, here. Anyway, would you agree that the incessant pessimism from the media is a plus for the bull market? To quote a line from the movie, I love the sell of pessimism in the morning. It reminds me of victory. I agree with that. I also look at the bull-bear ratios, and the bull-bear ratios aren't particularly overcrowded with bulls, which is a good sign. Yeah, it looks like the sentiment. I mean, look, the fundamentals are great. The earnings story has been phenomenal. And As I pointed out, if you kind of take this bull market starting way back when, a few months after the bear market caused by the pandemic, and you get sort of a full recovery from that bear market. From that point on, the S&P 500 is up 100%. Forward earnings are up 100%. The strength of earnings so far this year has been really remarkable under the circumstances of all the turmoil created by Washington's policymaking. Finally, Chip, what are your thoughts on the market melt-up pulse with Elon's Friday 1 billion open market Tesla purchase that sent the stock the roaring 20? Yeah, I mean, these are all roaring 2020s kind of developments, just let's buy stocks. Let's buy, well, I was going to say let's buy Bitcoin. Let's buy gold. Maybe everybody's buying Bitcoin, gold right now and kind of waiting on Bitcoin. The meme stocks are roaring again, IPOs, M&A activity. The good times are here. And I don't really have a problem with that. I'd like to keep it going into the 2030s, which I guess is why I've kind of overstayed my welcome here on the notion that the Fed shouldn't lower rates. But I keep forgetting my job isn't to tell the Fed what to do. My job is to say what the Fed's going to do, and they're going to cut. Okay, we got one last one. Thank you for staying with me. Do you think there are canaries in the coal mine when looking at the enthusiasm for Bitcoin tokens and SPACs? We'll see. I mean, I think so. The Bitcoin's got a huge potential market, and that's all the people like me who haven't bought it and don't particularly understand why it's at this level, since it's got no no income that it generates that we can value it with. But it is what it is. Let's see what stablecoin looks like. For now, I don't see anything that's radically changed in that marketplace. Well, with that, let me thank you all for joining me. Let's do this again next week. It should be interesting this week, obviously, but as always is. So thank you. Bye bye.